us going from the low price here to the high price here. As it starts to cross through these price areas, we started to tell everybody that this was a change into a parallel shifting market, which was a steepener, which is exactly what's happened to bonds. Does everybody remember we had that conversation before the non-farms today, yeah? Did we have this conversation before non-farms? For those that just joining us, just in case you don't quite understand what we were talking about. So we talked about this trade being a parallel shift before the non-farms, which means we're expecting bonds to continue selling through that period. That's what a parallel shift tells us, right? That conversation took place around about 11 o'clock, 12 o'clock, or somewhere around about those times. Those times. Well, you can see what happened to bonds after the conversation. The parallel shift steepening continued to play out through the non-farm payrolls, which was the sell trade that we talked about in the classroom before the non-farm payrolls even came out. So it gave the bond traders a real clear opportunity to take a run at this, knowing that this parallel shift, because we could recognize the correlation coefficient going into a parallel shifting phase, which is what we were actually discussing, makes an awful lot of sense. Because this is a slowed down version of, obviously, the twist takes place here. And when the twist takes place there, you can see the parallel shift takes place here. It's still negative, so the twist is just getting into position. And then it moves into the next parallel shift, which is this phase here. And you can see that that parallel shift is starting to shift back out again here. And we can see that that parallel shift is starting to shift back out again. And that's something we can start to look at. We can start looking at those shape shifters. We love a good shape shifter, guys. But what my expectation is actually is that probably Nessie will reach a conclusion about the class we did this morning before I can even send the email out. So probably that'll be the case, one would imagine. I do have a FTSE pound spread on, just because obviously I've been showing this, and it's been spreading up and it's been spreading back down again, and I've just been waiting to make the big monies at it. But this is how it's evolved here, and so this is how it's evolved here. You can see that the trade is the pound FTSE. So there's the contract that we're trading. So I have 6B contracts and I have Z contracts. I'm short the Z and I'm long the FTSE. Short the Z, long the FTSE. So you can, short the Z, long the pounds, right? So you can see what we're doing. The first opening trade was break evens. The second open trade, we'd started to lose a little bit of money. Then we started to make a very small profit on the spread, and now we've moved into a double alpha profit on the spread of $1,000. Now it's not very much considering we've got 25 spreads in it, but still, it's $1,000. Still $1,000, isn't it? Even regardless of the fact that we've got a 25 spreads, it doesn't make much of a difference. And we've just been building into that spread. And as I said, it's not about the size of the profit on these types of trades. It's about the size and volume we can get onto the trade, because it is effectively an index arb. It's not an index, but it's effectively a pure statistical arbitrage trade, as opposed to a pure arbitrage trade, and opposed to a spread trade, which isn't an arbitrage, but it's getting closer to arbitrage. But this really is more in line with a pure statistical arbitrage basic trade that we do in the bank probably 200, 300 times a day, basically.